Hey guys, if you are in the market to buy a home or refinancing, or if you're just in a mortgage transaction period, there are some don'ts that you definitely don't want to do. Roger and I are going to go through three of the basic components of a mortgage and why these don'ts are so important. This series will be made up of three parts. We are going to talk about credit first, and then income, and then assets, and all the don'ts that you don't want to do.
Thanks, E. So today we're going to first cover the do nots, the don'ts for regarding credit.
Okay, would you say that credit is arguably probably the most component of them all? And then let me explain to you why, right? Because you can make more money in the form of a raise or getting a promotion or even getting
changing jobs.
Exactly.
Yeah.
So you can manipulate income fairly quickly, right? If you have the ability and the skills to do so. Assets, you can always have more money. There's different ways of doing that by getting a gift, et cetera, et cetera. But credit, I mean, if you have a ding on your credit, let's say, a collections or a charge off, or even something like 30-day lates, it doesn't just fall off your credit report the next month, right? Yeah. So there's a lot of components that impact your credit score and your credit rating.
Correct.
Okay. So let's dive into some of those components of what you should not be doing. Yeah. I mean, we're making the assumption that the audience we're speaking to is already engaged in a mortgage application, but let's even give them a little information on, hey, before you even apply, these are the things that you want to avoid.
Yeah. Yeah, so the first one that comes top of mind is don't open new credit, right? So whether you're in the process right now purchasing a property, you're in escrow, or you're preparing yourself, so you're in the TBD, what's called a TBD pre-approval stage, before getting into a contract, just don't buy anything, right? The obvious one is don't finance a car, don't finance a boat, but don't also co-sign for someone who's purchasing a car or a boat or a house, nevertheless, right? Because we have to now factor that debt. Though you're a co-signer, you're equally responsible for that debt. And that debt now will have to be factored into your own personal DTI for qualifications, the debt to income ratio that is. So don't co-sign for anything. But even smaller credit cards, right? So I really recently just had a client who's in escrow right now, and they went to Sam's Club and they opened up a new Sam's Club card. Well, so here's the premise before I move forward. When it comes to credit, the lender's going to find out.
Yep.
Okay?
You can't hide it.
You can't hide it because let's just say there are other mechanisms that lenders have that will find out whenever a new credit report is pulled. Your name goes is added onto title because mom or dad or uncle or auntie wants to they're of older age and we want to leave something, and they're going to add your name to title. That will come up. Okay, there are tools that lenders have, and usually these tools are utilized towards the end of the mortgage loan process, and so we're gonna find out. So just don't do it. But right, going back, credit. So he opened up a Sam's Club card, and sure enough, we're towards the end. It's right before CTC. Okay, CTC is an acronym for clear to close. That stage is critical because then it allows us to get docs out. But right before CTC, we get this alert that he opened up a new credit card. And he did, in fact, open it during the escrow period. And so we're like, now we have to go back and ask him, hey, did you buy anything? Did you finance? Did you charge anything on the card? We need a statement now to go off of, because it's a new debt and it's not going to quite yet reflect with the credit bureaus, Equifax, TransUnion, and Experian. We need to go off of an alternative document being a statement. So now we have to wait for that statement.
Yeah, and sometimes when you open up a new credit card during the billing cycle, you may not get that statement for like 45 days.
Yeah. So it's a hassle. Are there ways around it? Yes, but just don't do it, right? Because you don't want to jeopardize your approval. So obviously, you don't want to co-sign and do large purchases, but also moreover, make sure you don't make any late payments. So I have another client right now who's unfortunately kind of in a bind, and let's just say because of larger credit utilization, they're kind of tapped out on their credit limit.
Yep.
And so when they came to me, this was already known. They let me know, And when we pulled their credit, it was about 672. Okay, not a great score, not a terribly bad one.
It's workable.
It's workable. Well, during this process now, like they're trying to do a line of credit or a second mortgage, and it's hard. So right now in this marketplace, while there are ample options to tap into your equity, if your FICO score is lower, it does hurt your chances of qualifying for one.
And even if you are qualified, you're going to get a higher rate because you're considered higher risk.
Yes, correct. But now what happened was, so we've been searching, applying, putting feelers out there. And there were some other delays on the borrower side, but week and a half passed and I get a text message and the borrower simply asks, Ragnar, we just missed our mortgage payment. And my first response was, okay, was this like a 10, 15 day late missed payment? And their response was, no, it cycled through a whole month. At that point, look, you're down to maybe one or two options. It's a very unfortunate situation. They just got denied too from the credit card company, trying to take out a personal loan or increasing their credit limit. Don't incur a late payment, right? A late payment being a 30-day late.
Right, right.
Especially if you are in that pre-approval stage and or in escrow. You don't want to make missed payments.
Well, at the same time, I mean, with Ragnar's case, the borrower is applying for a home equity product, probably for some payment relief.
Yeah.
Okay.
Yeah.
Look at it from the lender's perspective. You're currently a homeowner. You're 30 days late on your first mortgage, and you're trying to use your home as collateral to get more financing.
Yeah.
It's a bad look. Just don't do that.
Yeah. Plain and simple. So don't take out new debt, whether it's small credit cards to large purchases like cars. Don't co-sign for any other new debt, especially for mortgages.
Yep.
And just don't make any missed payments.
Absolutely. And I know that the home buying process, this is a time of joy and excitement. And, just to share one of my stories, I actually had a couple who got so excited in the middle of escrow. They went to Best Buy and they fell victim. Nothing wrong with Best Buy. Everybody's pushing products and services to generate revenue. I get that. But as consumers, we feel more and more pressure every time we walk into a retail location, being asked to apply for a credit card to save 10%, 20%, whatever it may be. But just know in the back of your head, if you're in the middle of a mortgage transaction, saving that 10%, that 20% can end up hurting you even more and causing you a lot of heartache. So don't be tempted. Just wait. I know you need to buy appliances and furniture and all that good stuff. And for a lot of first-time home buyers, the only way to finance these is by opening up credit cards and financing them. But don't jump the gun. Let's secure the home first. Let's close that. I'd rather you sleep on the floor for a week versus you jeopardizing closing on your home.
Yeah. I forgot one.
Okay.
You just reminded me, I don't know how, but leases. Don't take on a lease either. I just want to, we want to make sure we're covering the whole spectrum, right? Yep. So it's not just about buying or financing a car. Don't lease a new car either.
Yeah.
Now let's just say, well, Ragnar, our lease is coming due. Okay, it's coming due. Now, thank you for letting us know. If you need to take on a new lease, well, just understand the ramifications, right? If you take on a lease, and now we are in mid of 2025, things are more expensive. If you're taking on a lease that's going to require a larger monthly payment, just understand it's going to hurt your DTI ratio, right? Meaning you can potentially qualify for less. If the lease is less, then it may better your situation potentially, but leases can also will have an effect as well.
No, that's a great point. I'm glad you brought that up.
Yeah.
That's something I think a lot of people, well, especially when we ask, what are your monthly responsibilities look like? A lot of people do forget about leases. Mm-hmm. And it's when we actually look at the credit report that we pointed out. Mm-hmm. So good point.
Yep.
Well, that's a wrap for the don'ts when it comes to the credit side of things when you're applying for a mortgage. Please stay tuned for our next video, which is going to be about the don'ts on your income. We'll see you next time.
See you guys.